We used to think of banks as a slow and steady earner, and then in the lead up to the financial crisis, we saw them as big money makers. But now, is it time to start to ratchet back to that old way of thinking? I'm here with Keith Bliss from Coutone. So we saw with Bank of America reporting this morning that the revenue was down 28% year over year. But are we starting to really kind of get these banks back to where they used to be, which is just a slow and steady company?
Yeah, that's right. Bricks and mortar banks. It used to be the old saying was bankers were 363 guys. They'd borrow at 3%, they'd lend at 6%, and they were on the golf course by 3 p.m. every day. I think we will get back to that. I mean, clearly some of the new regulation, the Dodd-Frank bill and the Volcker rule, whatever iteration it gets into, will curtail a lot of the risky activities that the banks took on over the last 10 years, and we will get back to them with just being lending institutions to commercial and industrial entities and homes.
What does that mean for the person that wants to invest in these stocks? Because they've been such a struggle to invest in because, I mean, like even look at JP Morgan's earnings, how do you even analyze a company like that? There's so many moving parts. It's not really a pure bank stock.
No, it's not. So JP Morgan is still a very far-flung, diversified financial services company, as is Citigroup. Wells Fargo and Bank of America have more core businesses. More revenues come from their core businesses than those two. So they are very difficult to analyze. When you get back to traditional banking, you will be looking at things like return on capital, return on equity. In the lending business, particularly in a low interest rate environment and a flat yield curve environment, don't expect to have great big blowout numbers of ROE and ROC in those levels. And they'll be trading at a PE of around 9 or 10. And that's where banks have traditionally traded, and that's where they'll be going forward.
Do you think that we're there yet in investors' mindset of ratcheting down these expectations, or do you think they're still kind of looking at them as to be a big moneymaker?
Well, there's still not been a lot of clarity on the regulations, so they're still looking at them to be a big moneymaker, especially, again, the very diversified firms like JP Morgan and Citigroup, although Citigroup had its stumbles going forward, Vikram Pandit, no longer the CEO, so on and so forth. But eventually they will get back to that. So what's really been pumping up the banks today is the central bank action, because the mortgage business has really ballooned at Wells Fargo and Bank of America, even though the revenues were down. So they're getting a nice boost from the central bank action. They're clearly trying to kickstart the mortgage business. We saw that in housing permits and mortgage applications over the last couple of weeks. So that's starting to filter into those earnings. If that continues for the foreseeable future, then they'll have good earnings. But at some point, we'll get back to a normalized market across all of those sectors. And as you pointed out at the beginning, they'll just be your old, staid, your grandpa's banking institution.
All right, well, I wish the central banks would just buy my mortgage instead of the mortgage-backed securities. That would sure help me out. So that's what we're going to do. We're going to keep our eyes on these banks, and hopefully investors will start to get more real with where those revenues should be.